So we start off with a big announcement from last week, which was made by Inenco regarding Rough. Essentially, what they've announced is that the facility is going to be offline from now until March 17, with no injections into the facility during that period. That's going to have the effect of dampening prices during Q3 and Q4, where we would typically look to inject into the storage facility. However, the big kind of upward risk that's going forward is going to be the inability to withdraw to the amounts we have done historically during the winter 16 period, which potentially could see prices for the winter increase. Moving to oil prices, we've obviously seen very little price action over the last few weeks. Oil prices have got up to 50, briefly traded above there, and have settled back around the kind of the $47 per barrel level, and at the moment are offering very little price incentive to UK gas and power. Finally, the main driver this week is going to be temperatures. We're expecting temperature forecasts to significantly increase. Now that's going to act to dampen gas demand, but it will potentially see higher demand for power as kind of AC demand in offices and homes increases. With that higher AC demand, there is potential for the need for more expensive forms of generation to kind of balance the supply demand of the market, which could see power prices climb this week. So we start off looking at short-term contracts relatively close to delivery, specifically gas. We've seen gas prices fall over the last week or so, and the expectation is that they're going to continue to fall this week, linked into the much warmer temperatures we're expecting and the subsequent knock-on effect on demand. As we've already mentioned, in terms of power, we're expecting potentially higher prices, and that's linked to higher AC demand, as obviously the temperatures get a lot warmer in offices and at homes. The AC demand is going to increase. Looking at seasonal prices, we've seen in terms of gas and power, both contracts for winter and beyond increased to fresh contract highs, and we're looking at comparative levels to around August last year. So we've clearly seen the bottom of the market at the start of this year, and from then prices have continued to increase, setting fresh contract highs almost on a weekly basis. So as we've mentioned, we've seen prices climb progressively over the last 6 months, and going forward the expectation is that prices could continue to climb going forward. So the recommendation for customers on a fixed price basis is to enter the market and fix as soon as you can. If you look towards contract duration, we're looking at probably 2 to 3 years as a minimum. The reason for that is if we look at subsequent seasons, there's a relatively small risk premium built in, whereas historically you would look to see a much more significant risk premium built into subsequent years. So if you fix now, that means that the difference between year 1, 2 and 3 is going to be relatively small compared to what it would have been 5 years ago. And that should help with mitigating some of the rise in non-commodity costs going forward. For customers with flexible contracts, it's down to your current hedge levels. If you've got a relatively high hedge already, there's not really that much incentive of increasing that hedge at the moment, given the kind of the volatility that we're seeing over the Rough storage announcement. However, those customers that are carrying a relatively low hedge, I would urge you to enter the market and increase that hedge level just to mitigate some of the risk going forward.